Section 3. Ongoing judgment that assets meet original and new selection criteria. The goal is for you to learn to continue to research stocks and cryptocurrencies, adding new selection criteria and keeping records of criteria score updates in order to see performance trends. Lecture 4. Track stock selection criteria performance over time. In this lecture, you will learn the importance of continually researching stocks, adding new selection criteria if necessary. Over time, assets should still meet original selection criteria standards, as well as new standards. Second, when new dates of data are kept for criteria, trends appear, enhancing stock analysis. This is our learning scenario. We started planning and researching to add blockchain stocks and crypto assets to our investment portfolio on Wednesday, May 5th, 2021. We will have bought our selected assets on Tuesday, June 1st, 2021. We have $100,000 and we want no more than 13% of that wealth to be invested in crypto assets, blockchain stocks, and cryptocurrencies. To be successful, we need to make a minimum of 12% on stocks and 50% on cryptocurrencies in 13 months to no more than 15 months. For that to happen, our assets must meet or exceed original and new selection criteria. To do this, we move to a new Excel spreadsheet that will take us from analyzing single date data to analyzing trends of multiple date data. 10 criteria were applied to the blockchain stocks under consideration. Additional criteria will be applied to stocks under consideration for purchase and tracking data trends. If an item is not numbered, free cash flow, shares outstanding, price, etc., it is something that we track, but we do not make it a selection criterion. For example, we want to know if a stock pays dividends, but we did not set a minimum dividend value in order to make a judgment call. We want to know price and free cash flow trailing 12 months, but these are not selection criteria. We will look at all of these categories. Across the top, our stocks are listed with their ticker symbol, sector, and industry. The blockchain stocks selected so far, Amazon, IBM, and NVIDIA, were not all in the same sector nor in the same industry. We are looking for a market cap for stocks of no less than $45 billion. Amazon has a market cap of $1.72 trillion. It is a mega cap stock. IBM has a market cap of $106 billion. It is a large cap stock. NVIDIA has a market cap greater than IBM's market cap, but less than Amazon's MCap. Its MCap is $767 billion, and it is a mega cap stock. Price. From start of research May 5th to purchase day June 1st, the price of Amazon and IBM decreased, but the price of NVIDIA increased. From June 1st to December 4th, the price of IBM went down, the prices of NVIDIA and Amazon increased. NVIDIA more so than Amazon. Dividends are payments made by some public companies as a reward to investors for putting their money into the venture. The decision to pay or not pay dividends is not likely to change. Outside of our scope, in the investment portfolio, to which this blockchain stocks and cryptocurrencies portfolio segment belongs, an investing instrument should have a minimum distribution percentage of 14%. Closed-end funds, master limited partnerships, MLPs, and real estate investment trusts, REITs, REITs, may be income sources that meet that threshold, but beware of extra tax filing complications and tax prep expenses that come with being a partial partner when owning shares of MLPs. Sales revenue. Amazon's revenue has grown over 3 years, 2018 to 2020. IBM's revenue has decreased over the same time. NVIDIA's revenue decreased in 2020, but in 2021 bounced back and exceeded 2019's revenue. Although NVIDIA's market cap is greater than IBM's market cap, NVIDIA brings in less revenue than IBM's revenue. This could indicate that the market is undervaluing IBM's revenue compared to NVIDIA's revenue. IBM's price per earnings ratio, PE ratio, likely is less than NVIDIA's price per earnings ratio. December 31st ends fiscal years for Amazon and IBM. January 31st ends fiscal years for NVIDIA. If you are in a position where you need stock information and cannot get that from a stock brokerage firm, consider using the Wall Street Journal at wsj.com/market-data. On December 4th, 2021, Amazon's earnings per share trailing 12 months of $51.11 is ahead of its industry at $34.11. IBM's earnings per share, EPS, TTM, trailing 12 months of $5.18 has fallen below the industry average of $5.32. That is why it is highlighted in orange. Earlier in the year, the industry averages were highlighted in orange because they were less than $5, our minimum. NVIDIA's EPS TTM is below $5 and below its industry average of $6.26. That is why its $2.80 is highlighted in red rather than just orange. Projected EPS growth. Projected earnings per share percentage growth next year versus this year on December 4th, 2021 was lowest for IBM at 4.42%, below our 5% minimum, and bringing down its industry average to 18.98%. Amazon's projected EPS growth next year versus this year at 26.33% also brought down the average for its industry, internet and direct marketing retail. NVIDIA's projected EPS growth next year versus this year at 19.82%, pulling up the semiconductors and semiconductor equipment industry average to 14.94%. Valuation. Amazon and NVIDIA have acceptable fidelity valuation scores, falling between values of 25 and 90. Falling outside of that range is IBM with a score of 96, 95, and 91. Let me remind you that the underlying factors for Fidelity valuation are adjusted free cash flow to price, book value to enterprise value, industry group, relative earnings before interest, taxes, depreciation, and amortization, EBITDA to price, inverse PE ratio, which is the earnings yield, adjusted for growth, and operating cash flow to equity. A stock price that is undervalued with reference to the book value per share would need to rise to book value per share, then rise to book value plus the amount to reach the net present value per share given an investor holding the company stock for 4 quarters and a day. A simpler measure for valuation is the price to earnings ratio. The PE ratio relates a company's share price to its earnings per share. Although the PE ratio can be a measure of valuation, a high PE could also mean the demand for the stock has pushed the price up as an indicator that investors are expecting high earnings in the future, not reflecting present but future realities. This would be an example for using the phrase, the market has already priced in ... The market has already priced in what? Higher future earnings. On this slide, for comparison, we see the company PE, and below it is its industry average PE. The valuations of Amazon and Nvidia have increased and are higher than their industry averages, whereas IBM's valuations have decreased and are lower than its industry averages. That does not bode well for IBM because we are looking for a PE greater than or equal to the industry averages. A firm's market versus real value provided by MacroAxis. MacroAxis is a small financial technology company which helps investors of all levels and skills to achieve their personal financial goals. It is a very sophisticated yet simple to use personalized wealth optimization service built for self-guided, socially responsible investors. A first stock selection chart and a second extended selection chart for new selection criteria to see trends in fundamental analysis can be formulated from MacroAxis. Fidelity Investments stock research is not needed to build a full, high-quality stock selection model. When we look at valuation at the macroaxis.com website, we see the market value of a firm per share, which is the price. Then we see what MacroAxis shows as the real value of a firm per share. MacroAxis arrives at the real or intrinsic value of a firm by quantitative analysis of company fundamentals and by taking into consideration essential factors such as a company's management style, its C-level domain expertise and tenure, its overall leadership history, capital structure, and future earnings potential. Comparing the two, market value and real value, we get a determination if the stock price of a firm reflects an overvalued, fairly valued, or undervalued estimation per share of that firm. On December 4th, 2021, Amazon was valued by the stock market at a price of $3,389.79 per share. Since MacroAxis arrived at a per share real value that was higher than that, $3,770.97, it is making a case that Amazon was undervalued by $381.18 per share. IBM was valued by the stock market at a price of $118.84 per share. Since macro axis arrived at a per share real value that was higher than that, $137.67, it is making a case that IBM was undervalued by $18.83 per share. NVIDIA was valued by the stock market at a price of $306.93. Since macro axis arrived at a per share real value that was higher than that, $321.94, it is making a case that NVIDIA was undervalued by $15.01 per share. If a stock isn't being ignored, demand can raise the price of an undervalued stock. Quality and growth stability, accrual ratio, return on invested capital, and working capital to sales are some of the underlying factors in the term quality as constructed by the research firms of S&P Global Market Intelligence for Fidelity Investments. Fundamental analysis section for a stock quote. As for Amazon, quality has drastically gone down from a score of 80 to a score of 49. IBM has improved from 87 to 92. NVIDIA has improved from 40 to 49, but is still below our minimum set at 55. Growth stability has three underlying factors: earnings per share stability, operating cash flow stability, where operating cash flow, OCF, measures cash generated by a company's normal business operations, and cash to adjusted enterprise value, where enterprise value, EV, tells you the theoretical takeover price if a company were to be bought. It differs significantly from simple market capitalization. For example, the value of a firm's debt would need to be paid off by the buyer when taking over a company. Enterprise value provides a much more accurate takeover valuation than market cap value because it includes debt in its calculation. Since May 5th, 2021, growth stability for Amazon and NVIDIA have stayed above the minimum score of 55, but IBM is terribly below with decreasing single-digit scores. 9, 8, 1. Financial health. Two factors for financial health are operating cash flow ratio and adjusted interest coverage ratio. Operating cash flow ratio, also known as liquidity ratio, is cash flow from operations divided by current liabilities, and adjusted interest coverage ratio, earnings before interest and taxes divided by interest expense, shows how easily a company can pay interest on its outstanding debt. Amazon's financial health has fallen under our par of 52 to NVIDIA's level of financial health, 45 for both. IBM's financial health is well above par at 86. Free cash flow, trailing 12 months, and free cash flow per share. Investopedia says free cash flow, FCF, represents the cash available for the company to repay creditors and pay dividends and interest to investors. Free cash flow can reveal problems in the fundamentals before they arise on the income statement. With the December 4th, 2021 row of data, IBM had the most free cash flow for the trailing 12 months, but we need to make this figure capable of being compared among the three stocks by converting FCF to FCF per share. Amazon had 507 million shares outstanding, IBM had 896 million shares outstanding, and NVIDIA had 2,500 million shares or 2.5 billion shares outstanding. In first place, IBM has $15.39 free cash flow per share. In second place, NVIDIA has $2.67 free cash flow per share. There are no positive dollars per share for Amazon. Its FCF per share is below our par. FCF per share needs to be positive. Free cash flow per share points to a firm's financial flexibility. A business may generate more cash flow than is required for operational expenses and capital expenditures. An increasing free cash flow to outstanding shares value is a positive because of the flexibility it brings. Profit margin. As of December 4th, 2021, the earnings before interest, taxes, and depreciation, EBIT-D margin, trailing 12 months, are led by NVIDIA at 38.92%, followed by IBM at 22.25%. Then in third place is Amazon at 13.09%. All three are above our 9% minimum and above industry averages. The IT services industry is struggling with this margin calculation at an average of negative 6.58%, even with the IBM positive contribution. Return on equity. On December 4th, 2021, return on equity percentage, trailing 12 months, was above 20% for all three stocks, easily clearing the 12% ROE set as a selection criterion minimum. However, IBM is not pulling up its industry average, while Amazon and NVIDIA are pulling up their industry averages. Whether an ROE is considered satisfactory will depend on what is normal for the industry or company peers. As a shortcut, investors can consider an ROE near the long-term average of the S&P, 14%, as an acceptable ratio, and anything less than 10% as poor. The S&P long-term average is 14%. In early December of 2021, the S&P's year-to-date total return was 26.85%. Price return of 25.16% plus dividend return of 1.69%. In light of that, my use of a 12%, only a 12% ROE minimum, could have been revised upwards. Not only that, our investment project Purpose and Procedures documents stock appreciation target also could have been revised upwards from 12%. But by definition, a market correction is a drop of 10 to 20%. So the ROE and stock appreciation target minimums do not have to be raised. Actually, stock appreciation target revisions need the input of analysts' price targets for the stocks that make our cuts. During research for the June 1st, 2021 purchase date, beginning May 5th, 2021, about a month earlier, 8 firms agreed they were bullish on NVIDIA first with a score of 8.3, Amazon second with a score of 7.6, and IBM third with a score of 7.4. December 4th, 2021, there was not only an update on analyst sentiment, but a deep dive into the meaning of the equity summary score. It is based on 8 research firms in the sector, not the industry, in the sector. What is their accuracy for the past 24 months? For Amazon, the bullish, then neutral, then bearish sector accuracy scores were not above 70 out of 100. None of the 8 research firms met our level of sector accuracy minimum for Amazon's sector, the consumer discretionary sector. For the IT sector, affecting purchase selection decisions for IBM and NVIDIA, of the 8 research firms, 3, less than half, met our accuracy minimum. Ford Equity led with an accuracy score of 93. Zacks came in second with a score of 87, and ISS-EVA was third with their sector accuracy at a score of 80. Regarding IBM, as a group, the 8 firms said they were bearish with a score of 3 out of 10. The most accurate firm was not saying bearish, it was saying neutral. The second most accurate firm was saying the stock would underperform. Conclusion: regarding IBM, research told us not to accumulate, not to buy the stock, or not to buy more of the stock on December 4th, 2021, if that were one of our purchase dates. Regarding NVIDIA, as a group, the 8 firms said they were neutral with a score of 4.4 out of 10. The most accurate firm was not saying neutral, it was saying buy, bullish. The second most accurate firm also was not saying neutral, it said outperform, bullish. Conclusion: don't use the recommendation of all 8 firms. Regarding NVIDIA, research told us to buy this stock or buy more of this stock on December 4th, 2021, if that were one of our purchase dates, because it would perform well with asset appreciation according to the most accurate firms. The information we had going into the June 1st, 2021 purchase date was shallow. Now we know how to dig deeper below the headline. Analysts' price targets. This slide should help us not fall victim to people who pump and dump items to trade. People who pump and dump talk up an asset to get people to buy it, and when the asset appreciates in price, they likely sell before you do, no longer supporting your asset purchase recommended by them. In our investing simulation on May 5th, 2021, we were researching and planning our purchases. The prices on that day for our prospective stocks are shown. TipRanks.com provides 12-month stock price targets combined from a number of analysts. A high target and a low target are given. I average the high and low targets to get a high-low average target price. First, use the planning date price of May 5th and see the difference from that price to the target. Amazon would have to appreciate 40.96%. IBM would have to appreciate only 1.91%, and NVIDIA would have to appreciate 67.72% to reach the high-low average target price. Second, use the price on the purchase date of June 1st and see the new distance from that price to the target price, because that day's current price will likely have changed from the research date price of May 5th. Amazon's price and IBM's price decreased, so their differences are longer and their price appreciation target percentages are higher. NVIDIA's price increased, so the distance to target price is shorter. On June 1st, going 12 months out, Amazon would have to rise by 43.09%, IBM by only 2.93%, and NVIDIA by 49.09% to reach the high-low average target price. We are looking for 12% or more appreciation in 12 months for stocks, but IBM is not slated to increase by that much. IBM then must be eliminated. Using a different team of analysts making price predictions, walletinvestor.com, the outcome is basically the same. Amazon and Nvidia are slated to increase more than 12%, but IBM is eliminated because it is not slated to increase more than 12%. Assignment for Lecture 4. Open the downloadable resource Excel file, Stock Data Trends, in the Assignment 4 Instructions section. Save this document, then save it with a personalized file name, for example, Stock Data Trends Student. A. If the one extra blockchain stock you added for consideration was selected for your stock purchase shortlist, add it to your stock selection criteria performance and trends spreadsheet, the Excel file, Stock Data Trends Student. B. Add a new date row or set of rows for all stock selection criteria in order to update the selection criteria performance and see if trends are continuing, reversing, or staying the same. Follow the example of the previous update. Update year-end sales revenue when figures are available. You will only be able to update the 12-month price targets and the 1-year forecasts if you are using prices from the day you do the assignment and are setting a buy date a month or less after that. See if you have one or more of your own new stock selection criteria to add to the file. Please do so. Make sure to set a minimum value for the criterion added. Populate the cells with the research data for each stock. Save the file. Answer the 2 questions in the assignment section of the course content for Lecture 4. This concludes Lecture 4. Track stock selection criteria performance over time. In the next lecture, we will do the same for our cryptocurrencies.